Okay, what if I told you there's a company out there right now just absolutely crushing it with a massive 47% revenue growth and a totally pristine balance sheet? I mean, sounds like an absolute dream, right? But what if I also told you that that exact same stock is hiding some of the most alarming fundamental metrics you could possibly find? We're talking a guru-focused score that literally suggests the worst possible future performance. So today, we're putting Pattern Group, ticker symbol PTRN, under the microscope in this explainer.
Okay, let's dive into this, because the cognitive dissonance we're looking at here is just wild. On one hand, you've got this explosive top-line growth and a ridiculous 129% net revenue retention rate. But then, on the flip side, you have incredibly poor fundamental scoring and, well, negative earnings per share. In today's explainer, we're going to objectively break down all 14 of these hidden flags, 7 red and 7 green, before running this highly polarizing stock through the ultimate frameworks of investing legends. Let's see where it truly stands.
But first, to really grasp the numbers, we got to know what Pattern Group actually does. Very simply, they're an e-commerce accelerator. They help consumer brands scale their sales across global marketplaces. Think of them as the hidden engine running behind the scenes. They use this proprietary AI-driven software that's powered by over 91 trillion data points. They hold 44 patents, and they integrate with over 30 global e-commerce platforms. We're talking Walmart, Tmall, Coupang, the whole shebang. It's a massive, massive operation.
But look, despite that massive scale, things under the hood are incredibly complicated. So let's look at the bear case, 7 blaring red flags.
Our second red flag, and honestly, arguably one of the most critical, is this number right here, negative $1.78. Despite all that booming revenue, Pattern Group is consistently unprofitable on a GAAP basis, posting a trailing 12-month earnings per share of negative $1.78. They actually reported a net loss of over $196 million on a trailing basis. And look, a company that can't generate consistent earnings, it's fundamentally speculative, no matter how fast it's growing.
Moving on to red flag number 4, insider confidence. Or, well, the total lack of it. Over just the last 3 months, insiders have offloaded over $167 million in shares. And the amount of insider buying during that exact same period? Absolutely zero. Look, when insiders are dumping 9 figures worth of stock and buying literally nothing, you know the market takes notice.
And this brilliantly illustrates red flag number 5, extreme revenue concentration. Out of their massive $3 billion in trailing 12-month revenue, a staggering 84% of it is tied directly to Amazon.com. This is a huge concentration risk, guys. If Amazon decides to tweak their fee structure, alter their algorithm, or just modify their third-party seller policies, Pattern Group's entire business model is heavily exposed to that single point of failure.
Let's rapidly batch the rest of these red flags. Red flag number 1, a disastrous GF score of just 19 out of 100, which quite literally implies the worst future performance potential. Red flag number 3, their Graham number is just NA because, well, you can't mathematically evaluate a stock using Benjamin Graham's conservative framework when the earnings are negative. Red flag number 6, the stock momentum has completely reversed. It's dropped 26% from its 52-week high to hover right around $21. And finally, red flag number 7, growth is decelerating. After a 47% growth rate in Q2, management's Q3 guidance signals a slowdown to somewhere between 31 and 34%. And as we all know, Wall Street absolutely hates decelerating growth.
Now, if we just stopped right there, you'd probably think this stock was headed straight to zero. But let's pivot and look at the bull case, 7 massive green flags.
Green flag number 1 is simply impossible to ignore. Explosive revenue. In Q2 of 2026, Pattern Group hit a record $877 million in revenue. That is a massive 47% year-over-year growth, marking their 4th consecutive quarter of 40+% growth. It's incredible. Brands that use Pattern Group, they stay with Pattern Group, and their spending actually expands. That's exactly what drives that incredible revenue retention we talked about. Now, remember that scary Amazon concentration risk we just talked about? Well, green flag number 7 shows that management is aggressively fixing it. Their diversification strategy into new marketplaces like Walmart and TikTok Shop is working exceptionally well. In fact, non-Amazon revenue jumped an incredible 93% year-over-year, and international revenue grew by 87%. So they are actively building their way out of that single platform dependency. Now, what's really interesting about all this is how they're actually funding this growth. Let's rapid fire the rest of the green flags.
They have a totally pristine balance sheet with $346 million in cash and absolutely zero debt. Their free cash flow is up 92% to $106 million, meaning they're funding their own growth, not just burning through investor cash. Plus, they possess a genuine competitive moat with 91 trillion data points constantly feeding their AI engine. Analysts overwhelmingly rated a strong buy with a target of $28.13. And to top the whole thing off, management is so confident that they actually raised their full year 2026 growth guidance to between 37 and 38%.
So, we have the ultimate tug of war going on here. Let's run it through the guru frameworks and let the legends weigh in.
Honestly, it's a brutal reality check. Benjamin Graham? Fail. He requires positive, predictable earnings, and as we saw, the Graham number here is completely unavailable. Peter Lynch? Also a fail. Lynch demands you understand the finances and look for a PEG ratio below 1. But with negative EPS, you literally can't even calculate a PEG ratio. Warren Buffett? Fail. An unimpressive return on equity of just 4.92% and absolutely no 5-year track record of profitability. So despite the massive 47% revenue growth, it is a clean sweep of rejection from Graham, Lynch, and Buffett simply because the earnings aren't there. Turns out, you can't buy shares with a 91 trillion data point AI engine.
And that brings us to the final verdict. What is the actual move here?
When you objectively weigh the scales of justice between this hypergrowth, data-rich e-commerce story and the harsh reality of its unprofitability, here's the clear action plan based on the data. If you're a value investor or a GARP investor following the philosophies of Buffett or Lynch, Pattern Group is a hard pass. The fundamentals just do not support it right now. However, if you're a growth investor and you're willing to bet on the data, moat, and market share capture, this definitely deserves a spot on your watch list. But don't just blindly buy in. You absolutely must monitor their path to consistent GAAP profitability and keep a very close eye on those share dilution trends because their outstanding shares have definitely increased significantly.
So, the crucial point is summarized perfectly by this classic Warren Buffett quote: "Price is what you pay, value is what you get." At roughly $21 a share right now, you are currently paying a premium price for an incredible revenue story, but you aren't yet getting the fundamental earnings value that actually protects your downside.
So now I want to turn it over to you. Looking at all 14 of these hidden flags, are you betting on Pattern Group's explosive AI-driven growth, or are those GAAP profitability red flags keeping you far, far away? Drop your verdict down in the comments below, and I will see you in the next explainer.